The long-term goal for dividend investors is to create a reliable and consistent source of passive income through dividends. Dividend investors seek out companies with a history of paying and increasing their dividends over time. By investing in such companies, or ETFs, they aim to benefit from the compounding effect of reinvesting their dividends over the long term, which can result in significant wealth accumulation and significant dividends later on in life. Now, with that, the ultimate goal is to create a portfolio of high-quality dividend-paying stocks that will generate a steady stream of income in retirement or as a source of supplemental income through their lives. Now, dividend investing can be a sound strategy for those who prioritize income generation or cash flow over only capital appreciation and are willing to hold their investments long term. Now, there's two extremely popular ETFs in the dividend investing community, and they are SCHD and JEPI. And they're both very popular for pretty good reason. SCHD ETF has one of the fastest growing dividends ever, and JEPI on the other hand gives you around a 10% starting yield right off the bat. But the real question we're going to solve throughout this video is which ETF is actually the best for a long-term dividend investor. But before we get into that, I just ask that if you haven't already, drop a like on this video and subscribe to my channel for more high quality content like this. So first, let's talk a little bit about SCHD and go over some of the fundamentals. The SCHD ETF is an exchange-traded fund that seeks to track the performance of the Dow Jones U.S. Dividend 100 Index. The fund's objective is to provide investors with exposure to high-quality U.S. large-cap companies that not only have a history of paying dividends, but also increasing dividends over time. The ETF invests in a diversified portfolio of dividend-paying stocks from various sectors, including things like consumer goods, financial, healthcare, and technology. The fund's holdings are screened based on criteria such as dividend growth, sustainability, and of course, payout ratio. Now, when an investor buys into the SCHD ETF, they are going to be provided with a convenient way to gain exposure to a diversified portfolio with very high quality holdings and also stocks that pay dividends and increase their dividends very quickly. But wait, there's more. All of this with an extremely small expense ratio. Now, according to seekingalpha.com, SCHD is up around 168% as far as share price appreciation since the inception of the fund just before 2012. SCHD does have a tiny expense ratio of just 0.06%. The dividends paid quarterly for SCHD and the assets under management is $45.77 billion. So it's definitely one of the biggest ETFs out there. Now, SCHD does offer a trailing 12-month dividend yield of somewhere around 3.75%, which in my opinion is extremely high considering you're going to get a lot of growth potential by investing into the names that are inside this fund. The annual dividend payout in dollars trailing 12-month is $2.64, and if history were to repeat itself, that number is only going to go up higher and higher as time goes on. SCHD has a 5-year growth rate of 15.56%, which is one of the fastest growing dividends in the industry. Now, to give you a quick breakdown of the holdings that SCHD has under their belt, it's very, very diversified, which I think is very key for any long-term investor. You want to be diversified, and you definitely don't want to put all your eggs in one basket. So the stock breakdown is in industrials, healthcare, consumer defense, financials, technology, some consumer cyclical, energy, communication, basic materials, and a little bit of utilities. Now, SCHD's top 10 holdings, in my opinion, are mostly absolutely bulletproof companies. We have PepsiCo, Merck, Coca-Cola, AbbVie, the Home Depot, Verizon, Amgen, Chevron, Pfizer, and Broadcom. So I think at this point, we've made it pretty obvious that lots of long-term investors would have an interest in possibly investing into something like SCHD. But on the other side, let's see what JEPI has to offer. So the JP Morgan Equity Premium Income ETF, known as JEPI, is an exchange-traded fund that seeks to provide investors with exposure to a diversified portfolio of income-generating assets. Specifically, the fund invests in a combination of U.S. and international stocks, bonds, and real estate investment trusts to generate income and, of course, growth. So although JEPI does offer capital appreciation, this fund is mostly concerned with income. Now, JEPI's top holdings are made up of a mix of stocks from traditionally stable and defensive industries known for their dividends. The consumer staples segment is well represented in the top 10. But note that JEPI also owns some non-paying dividend stocks, things like Amazon or Alphabet. And it owns some of these names because they're able to generate high amounts of income through derivatives or options to generate income to pay the shareholders. Now, since JEPI has only been around just before 2020, there's not all that much data to go off of. But since the inception of the fund, it's up around 5.61%, which again, you're not going to see this fund move up in price all that much most likely, because this fund is mostly geared towards income generation. But here's the real reason and arguments why a lot of people want to invest in something like JEPI. JEPI's dividend, the trailing 12-month dividend yield, is around 11.37%, which is obviously much higher than SCHD, right around 3 times as high. Now, as far as growth rate of dividend, you aren't really going to be able to rely on JEPI to be raising their dividend all that much from here, where on the other hand, you can definitely expect SCHD to continue to raise their dividend for years to come. One thing that's cool about JEPI is that it does pay a dividend every month, so some investors that maybe are a little bit closer to retirement or something could use this dividend income paid by JEPI to cover bills or just pay for life expenses. Now, JEPI's holdings are also rather diversified, but remember, JEPI also uses a covered call option strategy, which really helps generate income. But the top 10 holdings are the Hershey Co., Pepsi, Microsoft, AbbVie, MasterCard, JP Morgan, Coca-Cola, Comcast, Progressive, and Visa. So now that we looked into some of SCHD's fundamentals as well as JEPI's, let's put both of the ETFs head to head on the charts and see which fund has returned more since inception. So if we go off of the metric total return, this means that dividends and share price are combined. Over the last month, JEPI's returned minus 0.07%, where SCHD is down more, over 4%. Over a 6-month timeline, JEPI's up 5.95%, and SCHD is down 1.67%. Year to date, JEPI is actually beating SCHD. JEPI's up 2.44%, where SCHD is down 6.83%. Over the last year, 4.03% in the green for JEPI, where SCHD is down 5.51%. In the 3-year time frame, which basically takes us back to around where JEPI was born. JEPI's up around 42.43%, where SCHD now takes the lead, up 56% over the last 3 years. Now for the 5-year time frame, JEPI no longer has enough data to really go off of, since JEPI was created in May of 2022. But over the last 5 years, SCHD has returned a whopping 72.84%, which is very impressive considering how the market has been over the past various years. So now that we've went over the basic fundamentals, we've went over the charts to see how both funds have performed over various time frames. Which ETF is the best for long-term investors? Now the simple answer is that it depends what the investor's strategy is. If an investor is looking to hold and reinvest and continue to do so over the long term, they would then most likely be much better off investing into something like SCHD because of the extremely fast dividend growth rate and because of the capital appreciation. But for those investors out there that might be a little bit closer to retirement, or for the dividend investors that want to start spending some of their dividends maybe a lot sooner than later, with JEPI's higher starting dividend yield, they are going to be able to get a lot more bang for their buck as far as income generation. So the reality is it really just depends on the investor and where they are at in life, how close or how far they are from retirement. For me personally, I own quite a bit of JEPI and I also own quite a bit of SCHD. I like the fact that I receive a nice sized dividend payment from JEPI every single month, which I can use that money to either cover a bill or reinvest the money right back into something else in the stock market. But I also hold SCHD and will continue to hold SCHD because of the absolutely staggering growth that the fund has had since inception, and for the simple reason that SCHD's dividend grows so fast. But I want to hear from you guys down below. Which fund is the best in your opinion for a long-term investor? Do you think it's JEPI or SCHD? And which fund are you buying the most of? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more. Thanks as always, guys, and I'll see you in the next one.